North American commerce is undergoing a seismic shift. For decades, the US and its neighbors thrived on open trade, but that era is ending. Since January, the Trump administration's aggressive economic nationalism has upended the old order, unleashing sweeping tariffs to protect American industries. These policies have ensnared not just rivals like China, but close allies like Canada, straining supply chains built over generations. Ironically, instead of simply bringing jobs home, these tariffs are pushing some American companies to look north for stability. Canada's consistent trade policies now make it a haven for businesses seeking predictability amid US volatility. The result, companies are redrawing their maps, sometimes finding it easier to trade with Toronto than with a neighboring US state. This series explores the policies behind this upheaval and how American businesses are adapting to a new, uncertain landscape. Tariffs, taxes on imports, are now the main weapon in America's trade arsenal. These duties are not just numbers on a spreadsheet, they have real-world implications that ripple through the economy. The Trump administration's 50% tariffs on steel and aluminum, and 25% on cars and parts, have hit even close allies like Canada. These measures were intended to protect American industries, but have had far-reaching consequences. The elimination of the de minimis rule means even small imports now face new taxes, squeezing consumers and small businesses. This change has made it more expensive for individuals and small enterprises to purchase goods from abroad. Canada retaliated with its own tariffs, but has since rolled some back, while US duties remain. This back and forth has created a complex and often unpredictable trading environment. This tit-for-tat has created a tense, uneven trading environment. Businesses are caught in the crossfire, struggling to navigate the new rules and regulations. Companies on both sides of the border face soaring costs and tough choices: absorb losses or pass them to customers. This dilemma is forcing many to rethink their business models and strategies. The result is a daily scramble to adapt: where to buy, where to sell, and how to survive. Businesses are constantly adjusting their supply chains and looking for new markets to mitigate the impact of these tariffs. These aren't just policy debates, they're reshaping business decisions in real time. Executives are making critical choices that will determine the future of their companies. The new tariff landscape is forcing a fundamental rethink of North American commerce. Companies must innovate and adapt to survive in this new economic reality. The USMCA was meant to guarantee tariff-free trade across North America. Yet, loopholes remain. The US has invoked national security to slap 50% tariffs on Canadian steel and aluminum, sidestepping the spirit of the agreement. This has created a patchwork system. Some goods flow freely, others face crippling duties. For businesses, this inconsistency is a nightmare. A manufacturer might import some parts tariff-free, but pay huge taxes on essential materials. The USMCA's shield is strong, but far from impenetrable. Uncertainty looms larger with a mandatory USMCA review set for 2026, and US officials already hinting at renegotiation. For Canada and Mexico, this means more risk and less incentive to invest for the long term. The rules of North American trade are no longer set in stone. Businesses must now plan for a future where today's certainties could vanish overnight. Facing rising costs and unpredictability at home, more American companies are pivoting to Canada. The economic landscape in the US has become increasingly volatile, with fluctuating tariffs and trade policies creating an environment of uncertainty. This has driven many businesses to seek more stable grounds. For some, it's cheaper to source finished parts from Canadian suppliers than to pay tariffs on raw materials in the US. This cost-saving measure is particularly appealing to industries that rely heavily on imported materials, allowing them to maintain competitive pricing. The auto industry, once a model of cross-border integration, is now seeing American firms explore Canadian partnerships to sidestep tariffs and stabilize costs. These partnerships are not just about avoiding tariffs, they also foster innovation and efficiency in production processes. Even consumer brands are shifting distribution to Canada, using its warehouses to serve North American customers more efficiently. The strategic location of Canadian distribution centers allows for quicker and more reliable delivery times. Canada's steady trade policies offer a rare sense of security. Businesses can plan long-term investments without the fear of sudden regulatory changes disrupting their operations. In a world where US rules can change overnight, predictability is a powerful draw. Companies are increasingly valuing the ability to forecast costs and plan investments with a higher degree of certainty. Companies need to forecast costs and plan investments, something Canada now offers better than the US. This stability is crucial for businesses looking to grow and expand their operations without unexpected financial setbacks. For many, the choice is clear. Invest where the ground is firm, not shifting. The benefits of a stable economic environment far outweigh the risks associated with the unpredictable U.S. market. Canada is becoming the go-to destination for American firms seeking stability. The country's welcoming business environment and robust infrastructure make it an attractive option for companies looking to secure their future. The trend is growing, reshaping the continent's economic map. As more companies make the move, the economic ties between the U.S. and Canada are strengthening, creating a more integrated and resilient North American market. These corporate shifts have real consequences for Americans. When companies buy from Canada to avoid tariffs, U.S. suppliers lose business and jobs. Tariffs, meant to protect American workers, can end up exporting opportunity instead. The most visible impact is on prices. Tariffs or taxes, and those costs trickle down to consumers. Since the new tariffs, Americans are paying more for everything from shoes to electronics, and even small online purchases now come with extra fees. Inflation is rising, eroding wage gains and squeezing household budgets. Uncertainty is also stalling job creation, as companies hesitate to invest or hire amid shifting rules. The result? Higher prices, fewer jobs, and a more anxious American middle class. The trade war's ripple effects are being felt in every home and every checkout line. The U.S. economy is caught between growth and growing pains as it tries to balance opportunity with mounting challenges on multiple fronts. While some sectors remain surprisingly resilient, others are feeling the squeeze. Tariffs are fueling inflation and uncertainty, threatening to undercut progress and making it harder for businesses to plan for the future. Global organizations like the World Bank and IMF warn that U.S. trade policy is now a major risk to both domestic and international growth, raising concerns about the ripple effects on global supply chains and financial markets. Tariffs drive up costs for manufacturers, who are forced to pass them on to consumers. This creates a cycle of rising prices and wage demands, putting additional pressure on both businesses and households. The Federal Reserve faces a difficult dilemma: raise interest rates to fight inflation and risk tipping the economy into recession, or hold steady and let prices continue to climb, eroding purchasing power. Meanwhile, legal battles add to the chaos, with courts questioning the legality of tariffs and the administration threatening to upend existing trade deals if challenged. This legal uncertainty only deepens the sense of instability. Businesses are left in limbo, unsure which rules or regulations will apply tomorrow. Many are delaying investments or hiring, waiting for clarity that never seems to come. This ongoing instability makes long-term planning nearly impossible, forcing companies to focus on short-term survival rather than growth or innovation. The very foundation of the U.S. economy is being shaken by policy uncertainty, as confidence in the system wavers and cracks begin to show. For now, companies and consumers alike are left to navigate the turbulence as best they can, hoping for stability but preparing for more uncertainty ahead. The U.S.-Canada pivot is likely to accelerate if tariffs persist and USMCA renegotiations grow more contentious. American companies are making long-term bets on Canada's stability, investing in facilities and supply chains that may outlast any policy shift in Washington. The risk for the U.S. is a slow erosion of its industrial base as capital and jobs flow north. The very industries tariffs were meant to protect could be hollowed out by the policies themselves. Policymakers face a stark choice: double down on economic nationalism or return to collaborative trade. The future of North American commerce hangs in the balance. For now, American firms will keep seeking safe harbor, and more often, that means looking to Canada. The next chapter of this economic story will be written by the choices made in Washington and Ottawa.